On Business Incorporated today. Africa graphite exports up. Implications for the continent's economy. Ghana expands gas sale to other African countries. And Zimbabwe begins fruit exports to China. Welcome to the program. I'm Ini John Mekwa. Well, let's begin as usual with markets in Africa. Starting at intraday, most of the markets that we track were in the red. The NSE index was the only gainer. It went up by 0.65%. This is following yesterday's sentiment after hitting a 4-year high yesterday as investors take position ahead of dividend payout. South Africa's JSE was down 0.14%, while in Egypt, the EGX30 fell by 0.41%. Meanwhile, Kenya ended Wednesday's session mildly negative. Well, we noticed that Kenya has been ending negative for some days now. We move over to the Middle East now, where sentiment in all the markets we track were fairly mixed. In the UAE, Dubai's main index posted a 0.80% gain, while the Abu Dhabi index advanced slightly. It was up just a tad. Elsewhere in the region, the Saudi Arabia's market indicator was down 0.12%, while Qatar index was printed in a 0.80% drop. That's intraday. We move to Europe now. Inflation concerns have dominated markets around the world in recent months, and investors are nervous over the U.S. Federal Reserve's trajectory for hiking interest rates and tightening its ultra-loose pandemic-era monetary policy. We have Rob Watts joining us from Berlin for the details now. Hello, Rob. Well, inflation continues to make headlines in Europe. What's the latest?
Well, yet another European country has announced record price rises for December. This time, it was the UK's turn. The British Office for National Statistics says annual inflation hit 5.4% at the end of last year. That's the highest figure for 30 years, and it is well above the Bank of England's target of 2%. The situation in the UK is, of course, similar to many parts of Europe. For example, here in Germany, inflation was 5.3% in December. Remember, this is all down to economies bouncing back from the worst of the pandemic, driving up demand at a faster pace than producers of goods, food and things like oil and gas can fulfill it. Energy, food, clothing and furniture prices all rose in particular during December in the UK. The Bank of England is now, as a result, expected to hike interest rates again next month, having done so last month too. Meanwhile, inflation elsewhere in Europe pushed 10-year German bond yields past the 0% mark and into positive territory for the very first time since early on in the pandemic. That's fueling speculation that monetary policy could also be tightened in the Eurozone too.
And we've been talking a lot about the US and the UK. Finally, they have begun talks on steel and aluminium import tariffs. Why is this so important at this time?
Well, this is important to the UK in particular because the US has already agreed to lift the Trump-era 25% tariffs on steel and aluminium imports from the EU. And that has in turn put British steel exporters at a disadvantage, so much so that some British steel production is actually being moved to mainland Europe to avoid the tariffs. So the UK government is now desperately trying to level the playing field with its European neighbours by getting these tariffs lifted as well. And it's taken until now for those negotiations to even begin. Both the US and the UK say they are looking for a quick resolution to the issue, but this has all taken longer than anyone might have expected when Biden took over the presidency from Donald Trump. He was clearly keen to improve relations with America's allies, but these tariffs are actually very popular in steel-producing states in the United States. So that is perhaps why he didn't rush to remove them.
Well, let's go to the markets now. It was an upbeat day on European markets yesterday. What drove that?
Well, the luxury goods sector was a key driver of European stocks on Wednesday. Shares in British high-end clothing brand Burberry rose 6.3% after the company said its full price sales accelerated in the third quarter. And also Richemont, the owner of luxury watchmaker Cartier, climbed 5.2% during the day. It was because of quarterly sales that leapt by a third during the last quarter, and that's because of robust sales in the Americas and Europe. Mining stocks also performed very well during Wednesday as raw material prices surged because of growing signs that stimulus is on the way in China. And we've also had some bigger picture figures for European companies. The 600 firms that make up the Stoxx 600 Pan-European Index are expected to post a 48.6% year-on-year rise in profits for the fourth quarter. That's a total of 109 billion euros, and that is ever so slightly higher than previous estimates.
And, well, we have to thank you so much, Rob. We'll get updates of today's trading tomorrow. Enjoy the rest of your day. So let's move on to the UK now. The Office for National Statistics has produced experimental household cost indices that can be used to compare inflation experienced by high and low income households. Well, we have Juliana joining us now to paint a picture of what this means. Hello, Juliana. Good afternoon.
Good afternoon, Inni.
So obviously this is an offshoot from the inflation figures that we've talked about. Please paint a picture for us what this indices is trying to tell us.
Yeah, well, according to the Office for National Statistics' latest data on economic activity and social change, it's revealed that 66% of adults living in the UK have reported an increase in the cost of living over the past month. That's 2/3 of households, and it's no surprising really because yesterday's data from the ONS2 also revealed that inflation is running at 5.4%, which is the highest in 30 years. It's pretty tough to fuel your car, to buy groceries in the store and pay your bills at the moment, particularly for those who are living on lower incomes. Now, yesterday, Andrew Bailey, the Bank of England governor, was speaking at the Treasury Select Committee in front of cross-party members of the British House of Commons. And he did say that, unfortunately, inflation is no longer transitory, as we realised at the beginning of the year, but is something that could be persistent for a long time, which has led to economists believing that the Bank of England Monetary Policy Committee, when they meet early next month, will raise interest figures from 0.25%, which was hiked last month, to about 0.5%, especially as we are now waiting for Ofgem, the energy regulator, to announce just how much they're lifting that energy price cap from £1,200 to perhaps over £2,000 a year, which is going to put several more families into fuel poverty.
Well, I'm so glad at least we have one thing out of the way. It's no longer transitory. And we have that. Well, moving on. Now, Primark is set to cut jobs, about 400. What's this about?
Yeah, Associated British Foods, which is the owner of Primark, they were actually, surprisingly, the biggest faller on the FTSE today. Their shares fell as much as 3.5% after they made their latest trading announcement, which revealed that in the 16 weeks to the first week in January, so basically the festive period, sales were down 10% compared to pre-pandemic levels. I think this took the market by surprise because, as well as Boohoo.com, JD Sports, Associated British Foods, or Primark as everybody knows it as, has done exceptionally well. They said that they're still struggling with supply chain issues, and they have decided that they are going to be axing 400 jobs. Now, 400, if you're one of those unlucky few, is a relatively large amount, but they do have in the UK about 29,000 staff. They have over 200 stores, so they're doing pretty well. But unlike their competitors, Primark doesn't have an online store. So anybody that is buying stuff online in Primark, it's not from the dealer itself. So they have struggled. We know that in November, Plan B measures were put in place. Millions of people were working from home, not doing their local shopping spree at lunchtime. And if you're at home, you're going to buy online. And unfortunately, Primark wasn't benefiting from that.
All right. And how's the market trading at this time?
The market's in the red, actually. It's dipped about 5 points after posting earlier gains, which took the FTSE All-Share to a 2-year high because of the lifting of Plan B measures. Even though the All-Share is down, a lot of the travel and leisure-related stocks are up. TUI, that huge tour operator, their shares are up 5% because there are suggestions that perhaps by the end of March, the Prime Minister and the Transport Secretary, Grant Shapps, will be lifting the requirement to test for fully vaccinated passengers. This is exactly what the Heathrow boss, John Holland Kay, has been asking for, as well as all of the other airline bosses. So that's given the FTSE a little bit of a boost, but sadly not the entire share. The all-share is down 0.02%. The FTSE 100 is down by 0.13%. And the FTSE 250, the domestic market, that's up at intraday by 0.11%. In the currencies market, the British pound is up on the US dollar by 0.09%, also up on the euro by 0.11% and up on the Japanese yen by 0.05% in A.
Oh, thank you so much, Juliana. Enjoy the rest of your day.
Thank you.
Let's move to the U.S. now, where U.S. stock futures were slightly higher this morning after another choppy trading session as investors remain cautious on rising rate, and the Nasdaq dipped into correction territory. Futures tied to the Dow Jones Industrial Average gained 76 points, while S&P 500 futures added 0.24%, and Nasdaq 100 futures traded about 0.42%. In regular trading, the Dow fell for the fourth day in a row by 339 points, and the S&P 500 also fell 0.9%. The Nasdaq Composite closed down 1.15% and now sits about 10% from its November record. This year's turbulence in tech stocks, set off by a spike in yields in the first week of January, continued yesterday as the 10-year U.S. Treasury yield hit a high of 1.9%. It started the year about 1.5%. In addition to growth stocks, banks also pulled back Wednesday despite strong earnings reports from the Bank of America and Morgan Stanley, both of which saw shares rise. Well, let's move to Asia now, where markets mostly rose today as China cuts its key lending rates. Hong Kong's Hang Seng Index led gains, jumping 3.42% to close at 24,952.35 as tech and property stocks rose. Mainland Chinese markets closed marginally negative territory, while the Shanghai Composite at 3,555.06 and the Shenzhen Component at 14,198.30. Stocks of Chinese property firms, which have been reeling under a debt crisis in the country, responded. The Hang Seng main properties index jumped 4.49% as Sunat surged more than 12%, while Shimao also jumped nearly 10%, and the Country Garden topped 3%. The rate cuts continue the PBOC's efforts to push down borrowing costs. And tech stocks in Hong Kong also jumped, with the Hang Seng Index rising 4.5%. Tencent surged 6.6%. Alibaba jumped 5.88%. And Meituan soared 11%. Let's see what's happening in the oil space now. We see that oil steadied today, clawing back losses earlier in the session as strong demand and short-term supply disruptions continue to support prices to close at their highest levels since late 2014. Brent crude futures fell 17 cents to $88.27 a barrel, while U.S. West Texas Intermediate crude futures were up 7 cents to stand at $87.03 a barrel, having also shed nearly $1 earlier. Supply concerns have mounted this week after Yemen's Houthi group attacked the United Arab Emirates, the third largest producer in the Organization of Petroleum Exporting Countries. Meanwhile, Russia, the world's second largest oil producer, has built up a large troop presence near Ukraine's border, stoking fears of invasion and subsequent supply uncertainties. In the metals market, prices of gold steadied near a 2-month high hit in the previous session, with higher U.S. Treasury yields preventing any gains amid caution building around development at the U.S. Federal Reserve's meeting, which is due next week. Spot gold was flat at $1,839.36 per ounce, standing near its highest since the 22nd of November. U.S. gold futures were down 0.1% at $1,840.60. Gold saw its best session in 3 months yesterday as a retreat in the dollar and geopolitical tensions surrounding Ukraine lifted safe haven appeal, sparking a rally in precious metals. Spot silver was down 0.1% at $24.09 an ounce. Platinum edged 0.1% higher to $1,022.60. And palladium fell 0.4% to $1,992.71. We'll take a break now. When we come back, we'll head straight to the African continent. We have a lot of stories there for you. Do stay with us. It's Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated on Channels Television. Well, just before we go to our commodities space, let's see what's happening in South Africa. We just got news that South Africa's annual inflation is just out and it rose to a near 5-year high of 5.9% compared with 5.5% in November. In December, the reading brought the average inflation rate for 2021 to 4.5%. Matching the central bank's estimated published at its November Monetary Policy Committee meeting. The latest rise has been mainly pushed up by shocking high fuel prices as well as the cost of food and non-alcoholic beverages. Headline inflation rate is now close to the top end of South African Reserve Bank's inflation range of 3 to 6%, which could strengthen the bank's case to further increase interest rates in the upcoming monetary policy meeting. And, well, graphite is a critical raw material in the production of electric vehicle batteries, laptops, mobile phones, pencils, and other electronic gadgets. China is currently the world's leading producer of graphite, with an estimated output of 650,000 metric tons. In recent times, Mozambique has been reported to have the world's largest deposits. And remember, yesterday we brought you the story that Tesla is now depending on Mozambique for the supply of graphite. Well, more fascinating is the news that the mine in Mozambique is operated by Australia's Sierra Resources and that Tesla is buying from there. Well, we have Mayowa Ige, analyst with Financial Derivatives Company, joining us now to give us the perspective of FDC on this new discovery and what it would mean to Mozambique and, of course, to Africa. Hello, Mayowa. Good afternoon.
Hello, Amy. Good afternoon. Thank you for having me.
Good to have you. So what are some implications of this shift from China to Mozambique for the supply of graphite? Especially we had Tesla and then now, a whole lot of supply. What does it mean to the economy, bearing the fact that we have the Australian company in between, the supply chain?
Okay, so I think it's just important to note that this the shift from China to Mozambique is mainly tied to geopolitics, right? The U.S. government wants to build their capacity to produce lithium-ion batteries on U.S. soil, and Tesla, being a U.S. company, just wanted to also reduce its dependence on China. But I think when we look at the past year, for instance, China has had a lot of issues with its supply of graphite. They had energy, they had the high cost of energy, power supply shortages, and as well as insufficient inventories. And so when we look at this, it's not hard to imagine that to come up to understand that the world needs another source of supply for graphite and to reduce supply chain risk, right? And so when we look at Mozambique having about 40% of the world's graphite reserve and also the largest low-cost mine in the world, the implication of this would be that we would see an increase in the supply of graphite, especially at a time when the demand for EV batteries electric vehicles and their batteries is increasing. But long term, I do not think that China would stop being a dominant player in the graphite supply space. I think that they will also increase their output. However, I think the proportion of their graphite supply would actually easy to reduce as Mozambique and other parts of the world also increase their own supply of graphite.
Yeah, so when you paint this picture now where the probability of China increasing its supply, and now we have supply from Mozambique, let's look at the trend for 2022. Won't this affect price? Would Mozambique not lose out in the economic benefits they are supposed to now that they are being the focus of the U.S.?
I don't think that Mozambique will lose out on anything. Let's look at this. We have the electric vehicle batteries. There's been an increasing demand for electric vehicles, right? On the back of that, we will most likely see an increase in demand for graphite, and also lithium-ion batteries, of which graphite is a core component of. Is expected to grow by about 35% this year alone, and even more in the following years. And so there's an increase. We keep on seeing an increase in the demand for graphite in the coming years. So the impact of this on the price is that we would actually see an increase in price. But when we look at the supply, yes, China would increase its supply, but at the moment, China's supply is low because of their New Year celebration. So after the New Year celebrations, which should be in like February, we would see towards the middle of the year, we'll see the price of graphite decline towards the middle of the year. But again, towards the end of the year, as more consumers want to stock up graphite ahead of the winter season, we'll see prices of graphite also increase again. So I think that with the growing demand for EVs, electric EVs, EV batteries, I don't think that the price of graphite would significantly decline to a point where Mozambique would not be able to reap economic benefits from it.
All right, so let's look at sub-Saharan Africa now. We've seen investment map has moved from precious minerals like gold, and it's now shifting to solid minerals like cobalt. And I mean, we talked about cobalt some weeks ago. What are the wider implications of this shift on the economy, on geopolitical map of the region and the spheres of influence?
I think we will definitely see a decline in, most likely see a decline in the influence of countries like Nigeria, right? Because, and then the reason why we would most likely see this is when we look globally, there's been an increase in the call for climate change, an increase in the call to shift from fossil powered fuels like oil to renewable sources of energy, electric vehicles. And so we would see a move as the years go. In the medium term, we would see a shift from resources like oil to resources like graphite and the likes. And this is where we would most likely see a shift in the sphere of influence to countries like Mozambique, especially Mozambique, because Mozambique has the largest graphite mine in the world, and also it's one of the largest natural gas reserves in the world. But I think the issue here, the risk to these countries achieving their influence and growing politically and economically is the resource cost, right? We saw it happen in Nigeria with oil, where we suffered the Dutch disease. And so I think it's more important that the governments of these countries channel the income they get from this resource discovery into I hope that they do not squander it and they actually channel it into investments and infrastructure that would give maximum benefits to their people. And we also would hope that they actually sign agreements with the foreign companies like Syria Resources that will be beneficial to them all.
Thank you so much, Mayowa. I also have some concerns around that, but we'll watch and see how it goes. Thank you so much. Enjoy the rest of your day. So let's see what's happening in Ghana now. In Ghana, we see that the state-owned oil company is progressing with plans to sell liquefied natural gas throughout West Africa after shipments of the fuel begin to flow to an import terminal this year. Ghana National Gas Company is working with partners interested in building infrastructure to sell LNG to domestic users and those within the sub-Saharan Africa. And then we move to Zimbabwe, where the country and China have signed a citrus protocol that allows the Southern African country to export fruits to the Asian economic giant. And the protocol requires that a cold chain system for the export of fresh citrus is what will be in place, unlike the initial requirement for cooling to begin on the farm. And that's how much you can take on the program. Thank you so much for being a part of it. We can do it again tomorrow. To join us then, I'm Ini Join Makwa.